The first annual conference of the Central Bank of Cyprus, the role of monetary policy in tackling inflationary pressures, is about to begin. Before the official start of the conference, we would like to briefly draw your attention to a few operational matters in order to ensure the smooth running of the event. First, please make sure that your mobile phone is switched to silent mode. For any further information or assistance that you may require during the conference, please don't hesitate to contact the Secretariat outside.
Esteemed guests, ladies and gentlemen, on behalf of the Central Bank of Cyprus, I would like to welcome you all to the first annual conference of the Central Bank of Cyprus, the role of monetary policy in tackling inflationary pressures. Prior to the official start of the conference, we would like to briefly draw your attention to a few operational matters in order to ensure the smooth running of the event. In front of you, you can find the final program of today's conference. For any inquiries or assistance during the day, please contact the Secretariat located outside of the room. And now, let us all welcome on stage the Governor of the Central Bank of Cyprus, Mr. Konstantinos Irodotou, for his welcome address.
Thank you. Dear Vice President of the European Central Bank, Mr. De Guindos, dear Luis, it is with great honor and pleasure that we welcome you to our conference today. Your presence as the esteemed Vice President of the European Central Bank highlights the importance of our discussions, and we look forward to your valuable insights. I also extend a warm welcome to our esteemed speakers and express my gratitude for their participation and useful contributions. To all our distinguished guests, your presence here today is deeply appreciated. Today's conference on the role of monetary policy in tackling inflationary pressures marks the commencement of a series of annual conferences hosted by the Central Bank of Cyprus. These conferences will address contemporary economic issues and challenges. We aim to foster fruitful discussions and a collaborative environment for shared research and learning. One of the most pressing challenges in our current economic landscape has been high inflation. Why is it so crucial to bring inflation down? The consequences of not acting and leaving inflation untamed would be dire. Inflation affects all of us, every individual, every family, every business, and consequently the economy itself. When left unchecked, inflation erodes the purchasing power of our income. Imagine a world where the cost of basic necessities, such as food, housing, and healthcare, increases by 10% or 15% or even more every year. A number of Eurozone countries witnessed such levels of inflation only last year. Households would suffer this cost, and the lower-income households suffer the most. Without an appropriate monetary policy response, we also risk entering a vicious inflationary cycle. If prices rise without control, people and businesses would expect higher prices also in the future. This expectation usually leads to increased demand for higher wages, which drives up the costs for businesses. Businesses, in turn, would then pass on this cost to consumers with further price increases. Monetary policy aims to keep such inflation expectations unchanged or anchored. Otherwise, a self-perpetuating cycle of rising prices could ensue, the well-known wage price spiral. Moreover, unchecked inflation can lead to economic uncertainty. Businesses, when uncertain of future costs and profits, tend to postpone decisions to invest in such a risky economic environment. This could stifle innovation, job creation, and economic growth. For the average citizen, long-term planning becomes a challenge. How does one save for a child's education or one's retirement when the future value of money could be so uncertain? Furthermore, without tightening monetary policies, disparities between the wealthier and the more vulnerable segments of society are likely to widen in an inflationary environment. Those with assets, like property or stocks, might see the value of such assets rise with inflation. In contrast, those relying solely on fixed incomes or wages could find themselves struggling to keep up with the rising costs. History has shown that periods of high inflation, for the reasons just explained, tend to create social unrest. In contrast, price stability maintains social cohesion and stability. So the societal well-being is a crucial outcome of price stability. Under the Treaty on the Functioning of the European Union and the Statute of the European System of Central Banks and the European Central Bank, price stability is the primary objective of the European Central Bank. Price stability ensures that individuals and businesses can maintain the value of their income and wealth and plan for the future with confidence. This not only helps the economy to grow, but also pave the way for job creation and prosperity. This brings me to another pivotal point, the symbiotic relationship between price stability and financial stability. The pursuit of price stability through monetary policy and of financial stability through macroprudential policy are to a large extent complementary. The primary objective of the European Central Bank is price stability, namely a 2% inflation rate over the medium term. However, monetary policy needs to take financial stability and the stance of macroprudential policy into account. Monetary policy and macroprudential policy operate through common transmission channels, meaning that the scope of interaction between the two policy spheres is wide. For example, the Central Bank of Cyprus, acting proactively, has recently increased the counter-cyclical buffer to 1% of risk-weighted assets for all licensed banks incorporated in Cyprus. The counter-cyclical buffer can work concurrently with monetary policy as it increases the resilience of the banking sector. During periods of stress, when losses might materialize, the central bank can release this buffer so that the banking sector can support the supply of credit to the economy, thus mitigating the impact of the downturn of the financial cycle. It is worth noting that the Central Bank of Cyprus is one of the 5 countries in the Eurozone that have enacted a positive cycle-neutral counter-cyclical buffer. The bottom line is that a stable price environment can foster economic growth and financial stability, while a stable financial system can make it easier for central banks to achieve their price stability objectives. Turning now to another important question, is the ECB monetary policy setting bringing price stability? The recent data on inflation affirms that monetary policy transmission is effective and having an impact on inflation. In addition, the ECB has managed to keep inflation expectations anchored, as most measures of longer-term inflation expectations currently stand at around 2%, which is the inflation target rate. As I mentioned earlier, this is important in order to avoid a wage price spiral. Although inflation has been reduced relative to 2022, it's still above the 2% target, but some of the transmission of monetary policy decisions that have been made still remains in progress. Based on the recent ECB macroeconomic projections of September, a continued inflation correction in the euro area is anticipated, with inflation decreasing from 8.4% in 2022 to 5.6% in 2023, and further decreasing to 3.2% in 2024 and 2.1% in 2025. As regards the inflation outlook in Cyprus, according to the latest Central Bank of Cyprus projections, also of September 2023, a significant reduction in the inflation rate is expected from 8.1% last year to 3.9% this year. This downward trend is anticipated to continue, with inflation decreasing to 2.7% next year and 2% in 2025. According to the same projections, the Cyprus economy will continue to exhibit resilience, with the GDP growth rate expected to reach 2.4%, 2.7%, and 3.1% in each year from 2023 to 2025. Unemployment in Cyprus is also doing well. It is expected to decrease to 6.3% this year compared to 6.8% last year. Despite the lower inflation that I just mentioned, material uncertainty continues to persist for the Eurozone, and that includes, of course, our country. For instance, the recent spike in energy prices could transmit to the rest of the economy again and have an upward pressure on prices. Furthermore, the elevated wages and profit margins observed in the euro area last year needs to be monitored closely, even though they are expected to normalize as we go forward. Also, the liquidity conditions in the euro area banking system can play an important role in the transmission of monetary policy and therefore inflation. Let me conclude by noting that addressing successfully the current challenges would lower inflation, secure the benefits I referred to earlier, and set the stage for new opportunities in our economies. For instance, an economic environment characterized by stable prices and financial conditions can support the much-needed efforts and investments related to structural reforms. These reforms can be directed to preserve and enhance the competitiveness of our economies through a transition to a more technologically advanced environment. This can be beneficial to all stakeholders of the economy and all members of society. Thank you for your attention, and I look forward to the fruitful discussions that this conference would undoubtedly foster. Thank you.
Thank you, Governor. I will now like to call to the podium Mr. Luis de Guindos, the Vice President of the European Central Bank, for his keynote speech.
Good afternoon, everyone. Let me start, if I may, thanking my good friend, Governor Erdoğan, for inviting me to speak here today at the first Central Bank of Cyprus annual conference. I will start by giving you an overview of the economic outlook for the euro area, before going on to look at how the ECB has adjusted its monetary policy to his outlook. I will then discuss in more detail the transmission of our monetary policy in the current environment and the sources of uncertainty that appear particularly relevant at this stage. Economic activity broadly stagnated over the first half of the year and is likely to remain subdued in the coming months. Weaker foreign demand and tight financing conditions are dampening growth, especially in the manufacturing sector. The services sector, which had been resilient so far, is now starting to catch down to manufacturing. The labor market remains resilient, despite the slowdown in activity, with the unemployment rate standing at its historical low of 6.4% in August. However, there are signs that labour market momentum is slowing as the economy weakens. The Employment Purchasing Manager Index, PMI, declined significantly between the second and the third quarters of 2023, despite a slight uptick in September. The services sector, which has been a major driver of employment growth since mid-2022, is now also creating fewer jobs. In September, ECB staff revised down projected GDP growth, as Governor Eroldo mentioned, particularly for this year and next, due to a greater contractionary effect from the tightening financing conditions and the weakening international trade environment. Beyond the near term, ECB staff expect growth to recover owing to higher real disposable income, thanks to rising wages and falling inflation, which is set to underpin spending. Inflation fell markedly from its double-digit peak last October, with the headline rate having declined to 4.3% in September. In the coming months, the sharp increases recorded in the autumn of 2022 will drop out of the yearly rates, lending further support to a deceleration in inflation. At the same time, underlying price pressures remain strong, although most measures of inflation have started to ease thanks to aggregate demand and supply becoming more aligned and lower energy prices in recent months being passed on to other parts of the economy. Labour costs are increasingly contributing to domestic inflation, while the latest data indicate that the contribution of profits fell for the first time since early 2022. Most measures of longer-term inflation expectations currently stand at around 2%, but the increase in some indicators need to be closely monitored. The September ECB staff macroeconomic projections see average inflation at 5.6% in 23, 3.2% in 24, and 2.1% in 25. When compared with the June Eurosystem staff projections, this is an upward revision for 23 and 24, which mainly reflects a higher projected path for energy prices, and a downward revision for 2025. ECB staff have revised down slightly the projected path for inflation excluding energy and food. This is on account of tighter financing conditions, which also reflect the restrictive impact of our monetary policy tightening and a weaker economic outlook. In summary, while inflation continues to decline, it is still expected to remain too high for too long. The ECB is determined to ensure that inflation returns to our 2% medium-term target in a timely manner. In order to reinforce progress towards this target, we decided to raise the three key ECB interest rates by 25 basis points at the September meeting of the Governing Council. This decision was informed by the three legs of our reaction function. First, the inflation outlook, in light of the incoming economic and financial data. Second, the dynamics of underlying inflation. And third, the strength of monetary policy transmission. Having raised interest rates by a total of 450 basis points since July 2022, we consider that the key ECB interest rates have now reached levels that, maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to our target. Our reaction function will continue to serve as the framework for future decisions, and we will continue to follow a data-dependent approach to determining the appropriate level and duration of the restrictive monetary policy stance. As part of this data-dependent approach, we continuously assess how monetary policy is transmitted to financing conditions, the real economy, and ultimately to inflation. In the current hiking cycle, the first leg of monetary policy transmission to financing conditions has been very strong. Compared with previous hiking cycles, firms' lending rates have increased at a faster pace and credit volumes have weakened more markedly. Transmission to the bank lending channel is likely to continue unfolding as lenders may become more prudent in light of rising funding costs and a slowing economy. Moreover, interest rates on outstanding debt will continue to increase as loans are progressively repriced. All in all, in my view, the transmission of our policy tightening to financing conditions seems to be well underway. The second leg of transmission relates to the way in which changes in financing conditions will affect the economic activity as firms and households adjust their plans for consumption, investment, and savings accordingly. The transmission of monetary policy tightening to the real economy is proceeding at a slower pace, with a substantial share of the transmission is still in the pipeline. For the economy as a whole, model-based estimates continue to suggest that owing to the typical lags in monetary transmission, the bulk of the impact of our tightening is expected to materialize only in the course of this year and thereafter. The downward impact of our tightening so far on GDP and inflation is estimated to average around 2 percentage points over 23-25 period, with the strongest effect expected on GDP growth this year and on inflation over the next 2 years. It is also worth noting that the speed of transmission varies across the euro area. In particular, the transmission to households is likely to be faster in countries where variable rate mortgages predominate over mortgages at fixed rate, as it is the case here in Cyprus. At the same time, uncertainties regarding transmission remain mainly in relation to the two sources. First, the current hiking cycle is unprecedented in speed. Moreover, it follows a long period of accommodative monetary policy and was accompanied by a recalibration of balance sheet policies, all of which limits comparability with historical regularities. And second, the tightening of our policy stance occurred in reaction to an unprecedented constellation of shocks hitting the euro area over the last 3 years, which had a disruptive effect on economic conditions and the inflation environment. The fact that we are still confronted with the overlapping legacy effects of these shocks may imply that monetary policy transmission is proceeding differently this time around compared with what historical regularities might suggest. The euro area and the world economy are also exposed to a variety of risks that accompany this monetary policy tightening. Based on our latest assessment, risks to economic growth in the euro area are tilted to the downside. Growth could be slower if the effects of monetary policy are more forceful than expected, or if the world economy weakens at a faster pace than currently projected, owing, for example, to a continued slowdown in China. The tightening impulse may be transmitted more forcefully to the real economy in an environment of this kind, owing to acceleration effects that often operate during periods of subdued growth and high uncertainty. Conversely, growth could be higher than projected if the strong labor market, rising real incomes, and receding uncertainty mean that people and businesses become more confident and spend more. On the inflation side, weaker demand, owing to the stronger transmission of monetary policy, or the worsening of the international economic environment, could put stronger downward pressure on prices than currently expected. Conversely, renewed upward pressures on the costs of energy and food, with oil prices, as you know, having already increased in recent months, and the unfolding climate crisis could push commodity prices up by more than expected. The role of wage dynamics and fiscal policy are of great importance in determining the future path of inflation. Wages have been catching up. Elevated wage growth is therefore embedded in our projections, albeit at a decelerating pace. But a lasting increase in inflation expectations above our target, owing, for instance, to higher than anticipated increases in wages or profit margins, could drive inflation higher, including over the medium term. Similarly, as the energy crisis fades, governments are rolling back the fiscal support measures implemented during the crisis. But a slower rollback of this fiscal support or an expansionary fiscal policy stance in the coming years would pose significant challenges to taming inflation and bringing it back to our target. The challenging macroeconomic environment requires a consistent mix of monetary and fiscal policies, with greater risks to price stability if these policies pull in opposite directions. To conclude, while we can be sure that our monetary policy tightening is transmitted forcefully to financial markets and is increasingly leaving a footprint in the real economy, the speed and scope of the transmission remain uncertain. This is partly due to the still fluid economic environment in which we are navigating, with the outlook for inflation and economic activity being rendered particularly uncertain owing to both the legacy effects of previous shocks and renewed risks. In addition, the current hiking cycle is unique, with the sequence of rate hikes being unprecedented in speed. Taking a longer-term view, structural changes in economic interactions may also exert upward pressure on inflation in a more fundamental way. At the global level, changes in trade patterns and energy markets, rising climate-related risks, and the commitment to decarbonize the economy, as well as geopolitical risks, may have longer-lasting implications, which could pose greater challenges to price stability. For these reasons, any assessment based on comparison with historical regularities and model-based estimates must be complemented by real-time monitoring of the transmission to financial and economic conditions. While there are signs of the strength of the first leg of this transmission, a substantial share of the transmission from financing conditions to the real economy is expected to still be in the pipeline, subject to longer lags. That's why this reinforces the need for a data-dependent approach to determining the appropriate level and duration of a restrictive monetary policy stance. Thank you very much.
Thank you, Vice President. We're moving on now to the second part of today's conference with two panel discussions coordinated by Mr. Grigoris Savas, journalist at Cyprus News Agencies. Mr. Grigoris Savas.
Hello. Excellent. Well, let me welcome you on my behalf. We have two very good panel discussions coming up. The first is on inflation and the ramifications on the investment and business decisions. We are joined by Mr. Sousa. Mr. Sousa, please. And also we are joined by Mr. Ernest Gnan, virtually. Mr. Gnan, can you hear us okay?
Perfect, thank you.
Excellent. Well, I will not, in the interest of time, I will not go on our two great panelists' CVs. I will just tell you they are real experts. Suffice it to say that Mr. Sousa chairs the Committee of Forecasting of the ECB, and also he's a Deputy Director of the DG Economics in the ECB. On his part, Mr. Gnan is a Secretary General of the European Money Forum, also known as SWERF, and he is an honorary advisor to the Governor of the Central Bank of Austria. So, you know how these formats are like. There will be a presentation or an opening remarks by each of our panelists, and then a discussion followed by a Q&A. So please, Mr. Sousa, you have the floor.
Thank you. I hope you can hear me. Yes? So thank you very much, and thank you for the organizers for inviting me here to this beautiful place. It's great to be here. And I'll try to present some of the recent developments on inflation. I think we had a very good, excellent initial speeches, and I'll try to put some numbers on some of the comments that were previously made, and give you an overview of where we stand now in terms of inflation in the euro area. So would it be possible to show the presentation, please? So in my talk today, I will just briefly recall the price stability mandate. I don't need to say much about that, but I'll try to explain what has happened in the recent years in terms of inflation in the euro area, how we got here, and how we see the process of disinflation going forward. And I also will show you some evidence of how inflation is affecting households and firms. So let me start with the price stability target of the ECB. This is if the target is to maintain inflation at 2% in the medium term, but it's important here to signal that it's a symmetric target. So upward deviations from the target and downward deviations are both bad in terms of the mandate. And this 2% target is crucial to create a clear anchor to inflation expectations. And this is very important in maintaining price stability. Now, where are we now in terms of inflation in the euro area? As you know, in recent years, inflation has come up and is very well above the target. It has reached, in quarterly terms, around 10% last year, and has since then started to come down. However, also there, you see that the process is not complete, and you see on the, besides the bar, you see our current projections of inflation going forward. And it shows that inflation is going to be above targets for a considerable period of time, and we only expect it to return by 2025. In the last monetary policy meeting of the Governing Council concluded that inflation continues to decline, but is still too high and expected to stay too high for too long. And therefore, this implies that monetary policy needs to continue to be vigilant and keep inflation, tame inflation, in the words of Governor Herodoto. Now let me go back a little bit and try to explain how we got here, also with the help of some charts. So here on the left is a chart that I usually like, which shows the pipeline pressure. So the pressures that are building up at the production, at the early stages of production before they get to the final prices. And you see here the green line is the energy producer prices. You see that over time, it tends to be relatively small and closer to zero. But starting in 2021, we really had, after the reopening of the pandemic, we really had an explosion of energy prices. And this was exacerbated with the start of the war in Ukraine, Russian aggression against Ukraine, and led to an increase that in the peak implied year-on-year growth rate of energy prices at producer level of 120% of GDP. This was 120% year-on-year. So this was a massive energy shock that affected the euro area. You see also another important shock that happened was the food inflation. You see the orange line also increasing very, very much after the start of the war, and also as a consequence of the increase in energy inflation. So all of these two shocks happened in succession of one of the other, and these shocks typically, energy shocks, if they are small, they easily are not a problem for monetary policy. Monetary policy, typically an oil price shock that is not lasting, monetary policy should look through. However, this becomes a problem when it starts transmitting to other prices in the economy. And this is what has happened in the recent episode. The chart on the right illustrates this in a clear way. You see clearly in the green bar, so this chart shows inflation and the contribution of inflation of energy, food, and all the rest, which is HRCP excluding energy and food, which we call the core inflation measure. And you see that at the beginning, the shock was mainly energy, and then we had food with the war. But also the orange part started becoming more and more important as we went along throughout the crisis. So it became more and more important component of inflation. So two special factors affected this core inflation measure. On one hand, on non-energy industrial goods, we had the famous supply-side bottlenecks. We had the containers, the shortage of containers, the COVID disturbances, the fact that there were labor shortages that implied a very strong increase in goods worldwide. The second factor that influenced core inflation was the price of services. Also, with the reopening after the pandemic, there was a lot of pent-up demand, and of course, a lot of demand for hotels, restaurants, etc. Those prices increased very, very much. More recently, we also saw an increase in wage growth. And all this is very important for services and contributed to this increase, say, in this more persistent part of inflation that you see there in the chart in orange, which implies that while initially most of the shock was related to energy and food, now it's starting to be more and more, the part that is domestic and more persistent, it starts to be more and more important. What is also interesting is that we see now the reversal of the energy shock, and of course inflation is coming down very much because of that, but the part that is more domestic and more persistent, the orange part, remains quite persistent, which implies that monetary policy needs to act to bring down inflation. Now and of course energy is also important because it influences all goods and services. Now let me show you another indicator that was also mentioned before, which is the indicators of underlying inflation. So recently, given all the shocks that inflation has been having, it has been proven useful to look at measures of underlying inflation, which is one of the pillars of our decision of the Governing Council, where we try to estimate what is the longer term and more persistent trend in the prices. And as you see, in a period of where we have price stability, so before we saw this big surge in inflation, all these measures tend to move more or less together. But of course, when we had the shock, these measures all went up, and the range of measures widened quite a lot. Of course, the measures that, some measures that have energy went up more quickly. Other measures exclude energy, some exclude clothing and food. I will not go through all of them. But it's clear that there's much more uncertainty about the true trend of underlying inflation, which makes the task of monetary policy much more difficult. And of course, it's important to monitor how these measures will evolve over time, because they will, we will hope they will start converging and narrowing, which will tell us that we are in the right direction. Now you see on the right this range in the shadow range, and of course the bad news is that all of the measures are above 2%, and are well above 2%. So there's no doubt that inflation is elevated and is above target. The good news in recent times is that it seems that this range is starting to come down. We see that we seem to have reached the peak, and this gives us some confidence that some progress has been made in terms of tackling inflation. However, you see here on the right, domestic inflation is still quite persistent and quite sticky, and also our measure of core inflation, seen on the right, has not yet come down very much. So it's still some way to go. In dashed lines, you see our forecast, what we expect for the next years, and we expect this underlying, HICP excluding energy measure to come down to 2%, but very gradually, and only reach 2% or close to 2% towards 2025. So this process of disinflation will take time, and will require that monetary policy is vigilant towards the risks that lie ahead. Now, of course, one important task of monetary policy, monetary policy, we all aim at having low inflation and also preserving growth, but it's important that monetary policy tackles not only the fact that to prevent short-term pressures, but anchors inflation expectations over the medium term, as was also emphasized in previous speakers. And the ECB has been raising interest rates since 2022, a very strong increase, unprecedented increase since the start of the euro. And you see on the right what has happened to consumer inflation expectations. From the point of view of a central bank, what is more important for us is the longer-term inflation expectations. In this case, we have a 3-year ahead inflation expectation, so the red line, remain close to target. You see that the shocks that we've had led to some increase in these inflation expectations, but it has not been so lasting and it has not been so wide, and recently it's becoming back to 2%. So to some extent, so we can conclude that the monetary policy was effective in keeping these longer-term inflation expectations close to the target. You see in the orange line, the 1 year ahead inflation expectations. These are more difficult to control because they depend more on what is happening in inflation in recent period. And you see that they went up at the beginning, but also more recently, they're starting to come down to some extent. So this gives us confidence that we are keeping inflation expectations under control, and this is something that we monitor very carefully. Of course, we also see that in the top that inflation has now come down, and we have this blue line, which is the perceptions of past inflation. And this measure is still a bit elevated. So it means that even though inflation is lower than what people perceive that it is higher than actually it is. So inflation has declined more than people's perception of inflation. And this is something that can create some difficulties, for instance, in wage negotiations. So if people perceive that inflation is 8%, when in fact now it's 4.3%, of course, this can imply stronger wage demands than if you would use the real number. So this means that the work is still not done. Now, let me now just give you some examples of why inflation is bad for economy and how it's affecting negatively consumption and consumers in particular. On the left, we have the Consumer Expectation Survey of the ECB, where we ask households what are their inflation expectations and what is their growth rate of GDP expectations. And this chart shows the link between the two of them. And what you see is that households expecting high inflation are the ones that also expect lower GDP growth. So clearly, there's a negative relation between inflation expectations and GDP. So those that expect inflation to be lower are also those that expect GDP to be higher. And this, of course, influences consumer confidence and consumers' expectations. You see on the right the measures of consumer confidence and what consumers expect for prices. You see the big spike that happened there in yellow that related to the start of the war in Ukraine, and this coincided with a strong drop of consumer confidence. And since then, we have seen some decline in expectations of consumers' prices and some recovery in confidence, but still to very low levels. The right-hand chart is very interesting because it shows the behavior of inflation and the behavior of consumer uncertainty, and you see that the two are very closely related. So actually, the time when consumers were more uncertain about the future coincided with the peak of inflation, and now that the inflation is coming down, this uncertainty, while still elevated, is also coming down. So clearly, an environment where inflation is high and uncertain is bad for consumer confidence. It will depress consumption, and we have been seeing quite weak consumption patterns in the euro area. And of course, that is bad for business and growth. Let me show you another important chart which relates to the income distribution and the fact that inflation hurts more the poorer. I mean, this is not just a theoretical concept, but we can show it in practice that this is the case. So here on the left, I show the consumption basket of a representative of the first quintile of the distribution of income, that is the poorer households, and on the right, the fifth quintile, the richer households. And you can see that the poorer households spend much more on this bar on essentials, on electricity, rents, and foods, and all these increase very much during this crisis. And of course, the rich spend much less of their income on these amounts, and they have a much larger amount. This is the dark blue bar, where they can discretionary spend on whatever they like, while the poor, of course, are more limited in their choices. And of course, it's important to take into account that the consumption patterns differ between the rich and the poor. And when you have a shock like we had, where energy and food is affected, this affects very much the poorer households. You see that on the right. The right shows the difference of the inflation rate of the poorer households minus the richer households. And it shows that during the peak of the crisis, the poorer households had an inflation rate representative of their basket that was much higher than the richer households. And this is also justifies why many governments had targeted measures to the poor to compensate for the effects of inflation. It's also interesting to see that more recently, with energy prices declining, this has inverted, and there's now some rebalancing of these two effects. And this is why also DCB is advocating that the government measures, especially those that are not targeted, should be phased out gradually, because the situation is improving. But clearly, inflation hurts more the poorer. Finally, I would like just to put some numbers also on the effect of inflation on the real wages. You see here on the left that real wages in the euro area have declined, so inflation is eroding the purchasing power of workers, and this shock is going to be quite lasting. So we only expect real wages to be back to the pre-inflation surge level by 2025, which means a long period where workers in particular will suffer from the effects of inflation. Of course, this also has consequences in terms of the wage dynamics, and will depress demand going forward. On the right, I show a decomposition of the GDP deflator, which is a measure of domestic inflation, where I show the contribution of unit labor costs and the profit margins. And what we see so far is that, as also was mentioned in previous interventions, unit labor costs have increased very much and have fueled the inflation. The green bars have become quite important because wage growth increases have been strong, and activity and productivity have been depressed. But also profit margins have been relatively high and have contributed to exacerbate the effect on inflation. Going forward, in terms of our projections, we expect that unit labor costs should moderate, but also the profit margins should have some compression. So the disinflation process will also imply the profit margins should come down somewhat from the current high levels, and we'll have a period of adjustment where firms will also have their margins compressed, also in the light of lower domestic demand. So in this sense, the disinflation process, so the inflation is hurting both workers but also firms going forward. The disinflation process will imply some adjustment in profit margins. But in the end, we should arrive at back to the price stability level, and all these transition costs will be over, and that will create certainly a better situation in terms of return of consumer confidence and growth. So just to conclude, so despite inflation coming down, we have still very high inflation in the euro area. This is whatever indicator you have to look at is still at a high level. We think that we see some encouraging signs in terms of progress towards the target, and underlying inflation seems to have peaked and inflation has peaked, so we seem to have been past the worst, but there's still some way to go until we get to 2%, and there will be the decline of inflation will be needed to go back to a situation where we don't have this arbitrary redistribution between the poor and the rich, and we also have lower uncertainty, more consumer confidence, and more investment and growth. And this concludes my presentation. Thank you very much.
Well, Mr. Knan, you have the floor.
Thank you very much for the kind invitation, and my apologies for not being able to be in Cyprus, in beautiful Cyprus in person, but I have another speakers engagement and I couldn't shift this. I'm going to share my PowerPoint slides for you now. Yes, can you see them? I hope you can see the PowerPoint slides. Okay, the title of my short presentation is Why Going the Last Mile of Bringing Inflation Back to 2% is Important.
This thing.
And I have to emphasize, of course, as all speakers from central banks and from similar institutions, that these are my own views and not those of my affiliated institutions, nor of the Eurosystem. So, pursuing 2% as an inflation target is a world-class standard among central banks in the developed world. You see here the various inflation targets of the various central banks, of the ECB, of the Federal Reserve System, of the Bank of England, and of the Bank of Japan. And they all, over time, have converged to a consensus that 2% inflation is the target to be pursued and to be used as a definition of price stability. There are some minor differences and nuances between these various formulations, but basically it's the same kind of target. Now, recently, some very renowned economists, including Olivier Blanchard, Mohamed Elerian, Andy Haldane, Lawrence Ball, have argued that central banks should not bring inflation back down to 2% because of various reasons, as they quote. The first reason is, according to them, the cost of slightly higher inflation is not really so big, and it has to be weighed against bringing inflation further down in terms of employment and growth costs. A second argument is that ongoing and forthcoming secular economic developments like climate transition, geopolitical tensions, and deglobalization, or labor shortages in Europe may put upward pressure on structural inflation in the years to come. Vice President de Guindos has referred to this briefly. Third, there is the old argument that actually a little bit higher inflation makes it easier for indebted bodies, including governments, but also private debtors, to get rid of their debts. So in a way, the argument is to inflate inflation away, to inflate debt away through the inflation tax. And finally, there is the economic argument that a higher inflation target implies also higher nominal interest rates, so higher key central bank rates, and therefore more scope to cut interest rates to fight future recession, to fight future recessions and crises. So your governor and also João have already mentioned most of the very, very important reasons which speak in favor of actually going back to 2% and bringing inflation really back down to 2%. And allowing inflation to stay higher is a bad idea. Let me therefore focus just on three aspects here. The first one relates to the third bullet here. Can you see my arrow when I move it?
Yes, yes.
Okay, so no indexation is perfect. You know, there is the old economic argument, a bit theoretical, it may seem to many, but they say it's no problem, whatever inflation is, 2%, 4%, 5%, 10%, if all contracts in the economy are indexed, then it doesn't really matter. However, in reality, as every business person and everybody who is experiencing inflation knows, no indexation is perfect. There is bracket creep. There are very, very few countries that have abolished bracket creep. So bracket creep means that with progressive income tax systems, a nominal increase in your wage implies a higher taxation of the additional nominal income, which of course, then leads to higher taxation overall and reduces the incentive to perform and to work. Furthermore, in this context also, there is the argument that insufficient depreciation allowances in the various tax laws do not ensure that after several years of inflation, a replacement investment can be done without being taxed on this expenditure. Let me then focus on the fourth bullet, anti-inflation government tax measures. Well, what we have seen in all the countries worldwide and also in Euro area countries, that in response to inflation, the various governments also take anti-inflation make anti-inflation emergency packages or whatever. Now, in many countries, this involves very strong state intervention in the price mechanism. So price caps on energy, price caps on whatever, on rents and so on. And of course, this implies a distortion of the price system and the loss of growth. Also, what we have seen over the past 1.5, 2 years is that various member states in the euro area take very different measures. So take the example of Spain, which used very strong intervention in the pricing system. There, the inflation as a result is very low. Or take a country like my own country, Austria, where the government initially took very few such interventions and just gave subsidies to the poor, which economists normally advocate. But the result is that this strengthened the purchasing power and actually fueled inflation even more. And we're now in a situation of, second round effects through very strong wage increases. Let me finally turn to the last argument, to the last bullet here, the legal boundaries. I mean, let's face it, the Maastricht Treaty, the EU treaty, states that the ECB is supposed to safeguard price stability. And it is hard to, while it can be argued that 2% is good as a price stability definition for various reasons, I don't want to go into this here now. The further you move away from these 2%, the less easily it is can be argued that the ECB actually achieves its mandate. And very similar lines of arguments have been, by the way, used by the Federal Reserve System and by the Bank of Canada. And let me elaborate on this last aspect a little bit. This chart here shows you various things. First, it shows you with the green line, the actual development of inflation in the euro area. It's actually blue here. So the blue line, this line here, shows you the actual development of inflation since the start of the euro area. So by the spring of 2023, when I wrote this article with the governor, from which this chart is taken, the cumulative increase in the price level in the euro area was just short of 60% over more than 20 years, almost 25 years. Now, the first thing that you see is that the cumulative increase of the price level in the United States over the same period of time was much, much higher at plus 100%. So basically in the 25 years or so, in the US, prices doubled since 1999. What I then also do is I show the free strategy review definition of price stability. I just assume 1.9% as inflation target. Then I take the post-strategy review inflation target of the ECB, which is 2%. This is what I showed you before. Most central banks nowadays have 2% as the inflation target. And what cumulative inflation this would have implied and would apply in the future. And you see that, in fact, the ECB's actual performance so far, even including the surge in inflation recently, is more or less in line with this 2% inflation target. So broadly, we're still on track. What I also show here is that had we had an inflation target of 3% or 4%, or had the central bank just tolerated a little bit higher inflation at 3% or 4%, then you would have seen much, much higher increases in cumulative price in the cumulative price level over time. So here you see plus 100% and plus 160% instead of the actual inflation development. So my point here is a very broad one. It is that even moderate deviations of inflation from the generally accepted target of 2%, so let's say 3% or 4%, over time, over a long period of time, make a substantial difference. So it is not unimportant whether the inflation target is 2, 3, or 4%, and it is very important that the ECB also, like other central bank, also takes the last mile to bringing down inflation to 2%. So let me briefly summarize. Even slight increases in inflation over a longer time accumulate to massive losses in money value. It is very hard to allow just a little bit more of inflation temporarily. As the governor emphasized, there is the risk of a loss of credibility, the loss of an anchor. There is more uncertainty. It is bad for investment. Joao showed very interesting slides in this context. Joao also showed that we cannot buy more growth and employment with higher inflation in the long run. So there is no trade-off in the long run. So therefore, I conclude that the ECB and the Fed and so on really are very well aware that they need to get the job done now, that they need to stick to the 2% target, that we need to avoid a rise in inflation expectations. So far, the ECB, as has been shown by previous speakers, has been impressively successful in keeping inflation expectations well anchored, also among households. We must not allow a loss in credibility, and we must avoid having to raise rates all the more later on, as the governor also emphasized already. Now, what has also been a little bit hinted at by previous speakers, but what I want to flesh out a little bit more is that other policy areas should actually support the ECB and at least act consistently. So there is the first area of fiscal policy. So fiscal support to the population should really be targeted. It should really be limited to the poorer parts of the population who really have a hardship because of inflation. But what governments should really avoid is inflationary fiscal expansion. And what they should also avoid to the extent possible is to damage the signaling function of prices. Now, there are certain trade-offs here. It's not an easy task, but governments should really avoid to counteract the ECB's fight against inflation and keep their budgets under control. The second policy area is competition policy. Now, in my country, in Austria, and I think this is the same in many other countries, and very likely also in Cyprus, there is really, a fight of words. The labor representatives accuse the enterprises to pursue greedflation, which means that they use the confusion about price developments to increase their profit margins, while on the other hand, the many economists in my country and also representatives of firms, they say that the wages are increasingly to blame for high inflation. So actually, these two sides of the social partners, as we call them in Austria, should actually cooperate and agree that there should be a joint effort to bring inflation down, to moderate profit margins, and also to moderate wage increases. And another aspect which is relevant here is the adequate transmission of monetary policy impulses to banks' retail credit and deposit rates. Now, in my own country, in Austria, a couple of weeks and months ago, there has been an ongoing debate that banks increased credit rates very fast in line with the ECB's increase in key interest rates, whereas with the deposit rates, they were lagging. And one of the reasons for this is, of course, the surplus liquidity, so banks don't have the need to get deposits from savers. So therefore, they can afford to keep interest rates very low. But at the same time, there's also the expectation by the public and by customers that there is some sort of symmetric behavior in that respect. And actually, banks in my country have really followed over the past couple of weeks to increase also deposit rates if they are, for instance, if deposits are bound for 1 year or so on. And the third aspect, the third important policy area is, of course, financial stability. And, it was briefly mentioned, the ESRB, the ECB is very well equipped to do this. There is the ESRB, which has an eye on the macroprudential policy developments. There is the ESM, which has an eye on individual banks' financial stability, and of course also at the national level you have the respective institutions. So it is very important to keep in mind that rising interest rates can pose significant problems for, let's say, the real estate sector, construction companies, but also other highly leveraged firms, and for bond investors, for institutional investors. And of course, the ECB and the various supervisory institutions have this closely in mind. And I will close with this. Thank you very much.
Well, thank you, Mr. Knan. Thank you, Mr. Sousa. Well, I have some questions from here, and each one I will be addressing them to the one, and the other one has 1 minute to add a comment to it. I will start with Mr. Sousa. Mr. Sousa, you've shown some data there that, okay, monetary policy seems to be, is bearing fruit. So the most important thing is how fast can we address the issue of expectations on inflation, which is, I think, the crucial point here for businesses and investors alike and the consumers.
Thank you very much for your question. I think, as I shown in my presentation, the tightening of monetary policy has been effective in controlling inflation expectations. So the charts I show are the from consumers, and there what is more important is to anchor the longer-term inflation expectations. If you look, for instance, at results from surveys, survey professional forecasters or market participants, you also see there that there's a strong anchoring of inflation expectations at around 2%. This issue has been very much in the light of the recent monetary policy decisions. Of course, to anchor inflation expectations is also important to have a very credible strategy to tame inflation. And we have, as Mr. De Guindos was mentioning, these three legs. So first, focusing on the outlook, which you constantly monitor, the state of the economy, and how the underlying inflation measures that I showed, and the transmission via the financial system that also Ernest talked about quite a lot. And all the three legs are showing that monetary policy is really being transmitted to the economy. We have demand now showing some signs of weakness in the third quarter. And of course, if economy starts being weakened, we have revised down our projections for this year and the next year. These, of course, will limit the possibility of firms to increase prices and profits in this environment, and should help contain inflation. And of course, all of this strategy has an important implication for inflation expectations. As also as Ernest was also mentioned, on the side of credit and transmission of monetary policy, both lending rates, the growth of credit, and also of money, which many have forgotten, and it's really declining. We see signs that monetary policy is being very effective, and and this is the reason why we think that inflation expectations at the long term have been so stable, and in spite of this huge inflation shock that we had.
Thank you. Mr. Gran, would you like to add something on this?
No, I think Joao made the point perfectly.
All right, excellent. Well, my next question is to you, Mr. Gran. I think you were very clear in your point on your presentation. It's a bad idea not to go the extra mile towards 2%. And the question is, how hard is for inflation to go the distance to the 2% target?
Okay, this is a very, very good question. You know, being an economist, I have the typical answer: on the one hand, on the other hand. And on the third hand, maybe even, no. I think there is a yes and a no, that it will be hard, or that it will be actually not so hard. Let me start out with reasons that this may be indeed the hardest part now, the last mile, so to speak, the last 2 percentage points. The reason is actually what Joao showed. Initially, inflation was driven by external factors, such as energy prices. Meanwhile, domestic factors, such as wage developments, profits, have become more important, and services inflation has become more important. So indeed, it is now for domestic policies, the ECB's monetary policies, the government's fiscal policy, competition policy to bring inflation back to 2%. Now, what should, on the other hand, help us in bringing back inflation to target fast and reliably are the following factors, in my view. First of all, the cooling down of the economy. It was mentioned before. Now, linked to this, of course, rising unemployment. The labor market is getting less tight. We have less labor scarcity, falling market power of enterprises, and thus falling profit margins. This is the first kind of factors. The second point is the fact that part of the interest rate hike is yet to show its effect on inflation. The usual lag is 1 to 2 years. João has mentioned this, so I really agree with him. So much is still in the pipeline from the measures that have been taken already. And the third argument is that the ECB's Governing Council has made its determination to bring inflation back to target very, very, very clear by stating that interest rates will stay high for as long as needed, and if needed, raising them further is not even excluded. This reassures the public, and indeed inflation expectations have moved up a bit, as initially even desired, because they were too low for very long. So they have moved up a little bit above 2%, but not by very much. So they are still in line with the target.
Mr. Sosa, you would like to add something?
I think Ernest did a very good job in mentioning this. Of course, something that is quite complex at the current situation is the high uncertainty that we have. I showed it in the chart on inflation, but also on the way that the economy is going to move going forward. And so it's important to measure all the aspects that, and this is why DCB, the Governing Council, has this data-dependent approach, where we need to monitor very carefully what is happening in all these dimensions. Because there's one important point mentioned by Ernest is the fact that monetary policy is not immediate, it's not exhausted itself at the moment, but will persist over time. So we need to forecast, we need to anticipate what may happen tomorrow, to try to calibrate the instruments the best way so that we bring inflation down and achieve, but at a way that is also credible, but also does not create risks also in the other direction. So all this process will need this constant monitoring of how we are relative to target and all the very aspects of transmission of underlying inflation and the outlook, so that we achieve the right balance and the right calibration to deliver our aim, which is going back to 2%, but also have growth and confidence and have price stability again.
Okay, I have a question for both. I will start with Mr. Knan. Mr. Knan, the question is, given in the light of the recent flash estimates for the September inflation is 4.3, the economy is cooling down. New lending has dropped to record lows since the inception of the lending survey by the ECB. And the question is now is, perhaps the rate high cycle has reached the plateau. Have we reached the peak? Is this question warranted?
This is a very delicate question because, I'm not member of the Governing Council of the ECB, so it is really for the Governing Council of the ECB to judge about these things. But what I can tell you is, and you have heard it, Vice President de Guindos and the Governor have made clear that the Governing Council follows a data-dependent approach. So if it is, and from this I conclude, this is my personal interpretation, yeah, it's not the official view. I conclude for myself that if it is clear that inflation, notably core inflation, which is the one ultimately relevant to gauge domestic price pressures, if inflation returns to the target of 2% with very high probability, then the Governing Council may, of course, pause, stop, or in the end, at some point, even reverse its hiking cycle. It all depends on the data and the economy. Both are very difficult to predict at this juncture. For sure, 1 month's inflation, on the other hand, is not enough to judge this. We will have to see this confirmed by further data. Now, you also mentioned the strong decline in the volume of credit growth, actually negative credit growth in some parts. Now, I mean, this is to be expected as a result of hiking interest rates. It is also to be expected as a result of the turn of the housing price cycle in several countries. Of course, once people don't expect anymore that housing prices will rise and rise and rise, and it's always a good investment, and taking out a loan for housing, for buying a house is getting more expensive, then of course the volume of credit declines, and housing makes up the biggest part of credit development. And the declining business sentiment then is also, of course, reflected in credit developments for businesses. But I'm sure that João has a much better answer than me because he is the master of data.
No, so I'm here in my personal capacity. So Mr. Herodoto is here and is a member of the governing council. And in the end, he and his colleagues are the ones who have to decide. But maybe I can just make some comments, not directly related to the question, but more on the inflation and the recent numbers. Of course, and maybe I mentioned some of the risks on inflation. Of course, everything will have to be based on the data dependence. The Governing Council is meeting in October and December. They will have to analyze all the data that is available and make wise decisions. But I think it's important, as I tried to convey in my presentation, that this is not an easy process, and it's not something that this uncertainty about inflation, as also Philip Lane mentioned very recently, is not something that is going to be solved very quickly. Of course, one issue, for instance, I can mention that in the forecast, we have a forecast for inflation in the fourth quarter of this year, 3.3%, so even lower than what we see now. So what we are seeing now partly is reflecting base effects on energy and also food that are now starting to kick in. So they were very high last year, and energy prices came down, especially gas. And this is showing up in the figures. But core inflation has been more persistent and is still above 4% and will be more gradually coming down. In this regard, I think there are two risks on the upside to inflation. One is on that inflation expectations become the anchor. We already mentioned that. The other one is behavior, wages, and profits. So it's important that going forward, both workers and firms and the negotiations that also NS have, bear in mind that inflation, we need to go back to 2%. And we need to assess very carefully how, in particular, these dynamics will go over the next few quarters. And also, there we probably need some time until we see the results of the wage negotiations to assess how the wage pressures are developed and being transmitted to final prices, to have a better grasp on where underlying inflation will go. Of course, on inflation, we have several other upside risks to worry about. So, of course, now energy prices have stabilized, but as Mr. De Guindos mentioned, we still have the risk that there could be adverse developments going forward, which in an environment of very high inflation, could create further difficulties to control. We have weather effects, climate change, very important for food. We are starting to see a lot more uncertainty on food prices, and this can bring back, again, surprises, because food is very relevant in terms of consumption goods and could need to renewed pressures on inflation. So all of this is worrying us on the upside. On the downside, we also have some reasons that could also give rise to some risks. We see that there's a lot of tightening in credit conditions. So the financial sector in general is quite robust, is in a good situation, but the banks are also tightening access to credit to houses and firms. And if this is done very forcefully, and this could end up with a stronger decline in demand and bring inflation more quickly to target. So this is our two, I would say, the upside and the downside risks that I would point out at this juncture that could also bring us either in one direction or the other. But the key word is uncertainty, and this will be with us already for some time until we are really in an environment that is much closer to price stability. And therefore, the job of Mr. Ototo and the Governing Council will continue to be very hard, as this has been so far, but I think a lot of progress has been made.
Okay, but you will be providing them the data on which they will take decisions, so. Well, thank you very much. Let's open the floor for questions, please. Anybody? Punto. We have the gentleman there. Thank you.
Thank you very much. Mr. Gran, it was Harry Truman who requested 100 economists, by the way. You mentioned in your presentation...
Can you hold the mic closer? We don't hear you very well. Thank you.
Yes. Thank you. Mr. Gran, your presentation was excellent, and I would like to comment where you said that fiscal policy should support monetary policy. I couldn't agree more with that. My question is, do you see governments in the euro area leaving the dirty job for the ECB? And I'm talking about doing what you and many other economists are dreading, and that is engaging in inflationary fiscal expansion. And I would like your comment and Mr. Sousa's comment on that, whether member states are leaving the dirty job to the ECB. Thank you.
Mr. Gran, you made some strong remarks previously on that, I think.
Thank you very much for this very valid question. Well, I think I have made my view on the role of fiscal policy pretty clear. Now, I would say it is, of course, the ECB's primary objective to pursue price stability and not government's job to pursue price stability. And governments don't on purpose shift the dirty job to the ECB, so that they don't act, on purpose in a non-constructive way. Governments just also face their own constraints and demands also from the electorate, and governments themselves are under pressure in the face of this high inflation. Now, I think most economists would agree, and João has also made this clear in his very good charts, that the reason for this high inflation is not because governments did something wrong or because the ECB did something wrong, but it was an external shock. It's an increase in energy prices, which are imported to Europe. And the result of such so-called negative terms of trade shock is that in the end, the importers of this energy and of intermediate goods that need to be imported to Europe, which become more expensive, that the importers, so the euro area citizens, all of us, we lose purchasing power, we become poorer, our welfare reduces. And then the question is, of course, how do you distribute this, this lower welfare, this negative shock to our income? And this is what we are currently experiencing. So is it more the enterprises or is it more the workers and so on? So, and the governments, try to navigate a wise way between all this. As a final thought, central banks can cope with this problem. It is central banks' job to be the bad guys and to take the punch ball away when it's needed.
Thank you for the question. I agree with Ernest. I think it's our job sometimes to take away the punch ball. The ECB position is also on this issue. We have, of course, it's important that governments abide by the EU framework, and it's important that we have clear fiscal rules to make sure that there's fiscal sustainability and high debt on the fiscal part needs to be brought down in respect of the EU rules. And also governments have an important role to play in terms of public investment. This is, for instance, in terms of the green transition, the digital transition. All these improve supply conditions and should help us reduce our vulnerability to these energy shocks that I showed. So, of course, we are part of this in this situation because we are still very much dependent on external sources of energy. And governments can do something in this direction. Where we have at ECB have asked the governments is is regards the energy support measures. So, what I showed, for instance, in my chart, clearly the poor are more affected by these shocks, and it's important that there is a safety net there. But what governments in some cases did was that the measures were not sufficiently targeted. So everyone was benefiting from those subsidies, those that needed it and those that didn't need it. And the effect of that is that you reduce the peak of inflation, but you increase the inflation the next year once you remove the measures. And this has led to some increase in the persistence of inflation. So for instance, in our forecast for 2024, inflation is a bit higher because we factor in that the governments will take away some of the support measures. And this implies that inflation will be higher for longer and will have consequences on the behavior of inflation. And of course, that's a risk to inflation expectations. And this is why the Governing Council has been asked governments to roll back the measures as quickly as possible, so that given that also the energy measures are coming down and also inflation is coming down, so that we don't have this problem of increasing the persistence towards the next year that will create more risk to price stability going forward and may require a stronger monetary policy response than would otherwise be needed.
Very clear. Well, please, anybody else? The gentleman there. Have another mic.
Thank you very much for your most excellent presentations and speeches. What I would like to ask is, with respect to the monetary policy transmission mechanism, and also if you see any connections between the current state of inflation and the negative interest rates we had, as well as the asset purchases and the balance sheet of the ECB's central bank, ECB's balance sheet, which is quite huge. We didn't hear anything about that, so I was wondering if you had any comments. Thank you.
Mr. Sosa, let's start with you.
For my side, I don't have any major comments on that. Of course, you are aware that we stopped the net asset purchases. We are now in a phase of some winding down of the portfolio, but these are issues that are still, in terms of the next phases, are still to be discussed. So I wouldn't have any specific comment at this stage. But of course, as the Vice President mentioned, when we analyze the current situation, we have to take into account all the unwinding of the measures that we had. For instance, the TLTRO that was supporting credit, that was unwind. All that is being factored into and we see a gradual decline of the excess liquidity situation. And that is something that we monitor on a regular basis. But other than that, I think the interest rate policy has been the main reference for the stance. And this is, in terms of our assessment of how it's proceeding, we think that it's going well, the transmission, and is being forcibly being transmitted to the economy. So in that sense, I think everything has been working as expected, and even as also the Vice President, we may need to see whether there could be some risks that, given the special environment we are, that it cannot be maybe be even stronger than in normal circumstances.
Mr. Kran.
Okay, now this is a very relevant and interesting question, and it, it is somewhat linked to the, I think, the assertion by some observers that the large balance sheet of central banks worldwide, so the expansion of the money supply worldwide, may also have contributed to inflation with a certain time lag. Now, I think I have nothing. There is a very interesting speech by Isabel Schnabel from a couple of days ago, maybe a week ago or so, which I really recommend reading. I mean, she really deals with all the arguments there in fair detail and in a very neutral and fact-based way. I think one conclusion that one can also draw is, in the end, it's the level of interest rates and not the amount of money in the economy that is relevant for the monetary policy stance. And the level of interest rates in the current so-called floor system, where the ECB sets a floor to market interest rates, to money market interest rates, this serves the purpose and in tightening monetary conditions in order to bring down inflation. Now, what was also mentioned in the question is the asset purchases, so the QE, quantitative easing. Now, in fact, as Joao has indicated, the quantitative tightening in a moderate way through a passive non-reinvestment in part of the portfolio, the APP portfolio. This has been initiated a while ago already, but much more importantly, the so-called TLTROs, the targeted long-term refinancing operations, the volume of these TLTROs has been really wound down dramatically over the past quarters, so that the balance sheet of the ECB overall, of the Eurosystem overall, has really sharply been reduced already. So the unwinding of the large balance sheet of the ECB has been, tackled actively and is well underway, I would say. Well, I hope I do the policy judge, good, yeah. I think Joao shares this opinion.
Well, we have time for another question, a brief one.
Good afternoon. Thank you for your presentations. Obviously, you focused your presentations on the importance of keeping inflation down, which I agree is very important, but sometimes having high interest rates for prolonged periods can have adverse effects and failures, like we've seen with some banks in the US and Europe. Where do you expect the next cracks in the financial system?
Okay. Mr. Knan.
Well, first of all, I would say interest. So what we experienced was a period of very long, very, very low interest rates. So what we have been now witnessing over the past 1.5, 2 years is, first of all, the first half of this period was clearly a period of normalization of the level of interest rates. And we have moved into restrictive territory only, let's say in the second half of this hiking cycle. So, and I mentioned the financial vulnerabilities in my initial presentation. Now, it is impossible for me, of course, to make any predictions there, because if one knew this, then it would be easy to prevent them. But if you look at the news and if you look at the comments, then I just need to summarize what I read by market commentators. So there are cracks in some parts, in some countries of the real estate sector. Highly leveraged construction firms are having a certain need to deleverage, to sell assets, and so on. Now, I don't say that a crisis is coming there, but this sector is, undergoing a big change compared to what the sector was used over the past 10 years. Then there are, of course, discussion among market participants but mostly for the US, less so for the euro area, I think, about stock valuations. That, the price earnings ratios and so on are quite high compared to profit outlooks, and taking into account the prevailing discount rate, that is to say the prevailing high interest rate and also the expected interest rate levels. So I think these are, I think the banks, we both are not supervisors, so we have little to say on this. Vice President De Guindos is the person in charge of financial stability in the ECB, so he knows 100 times more than we. But I think if you look at the last financial stability review and also at the stress tests that have been published by the ECB and the ESRB, then you see there that European banks are well equipped. They have increased their equity positions sharply compared to the great financial crisis. And there was no spillover from the difficulties of some US banks to the euro area. So I hope this partly contributes to answering your question.
Yes, I think. Well, thank you. Fortunately, we have no time for Mr. Sosa. Good for you, I think.
That's fine.
So we will move to the next panel. Thank you, Mr. Knan.
Thank you very much for having me.
Okay, you may go. Well, we'll now proceed to our second panel. It's a Cyprus-centered panel focused on the Cypriot economy, on the outlook and opportunities. Of course, our panelists need no introduction. We have Mrs. Serini Bigi, the Deputy Minister to the President, please. Mr. Panikos Nikolaou, Chairman of the Association of Cyprus Bank, and Mr. Evgenos Evgeniou, Chairman of Invest Cyprus. Welcome. Well, and we will begin with a keynote presentation by Ms. Bigi. The floor is yours.
Yes, thank you very much for
the mic.
Hello? Okay. Thank you very much, first of all, for the invitation. And thank you to the Central Bank for initiating such a topical discussion on inflationary pressures. I mean, the role that the Central Bank has to play, as well as other independent national authorities, is really important in maintaining both economic and financial stability in the face of global inflationary pressures. In this environment, there's indeed increased pressure on the government to take action to mitigate the negative impacts on the economy regarding inflation, both for the people and for the businesses in the country. So the weight on the decision makers is intensified by the complexity of the current inflationary crisis, for which we had very interesting discussion before. So the government at this point needs to weigh very carefully its decisions in order to strike a balance between, on the one hand, fiscal policy, a responsible fiscal policy, a prudent fiscal policy, macroeconomic stability, as well as the protection of the social fabric of the country. And we always keep the latter into account. I mean, the government was elected 7 months ago. The president's program is has a people-centric approach, which is applied across all reforms and investment in the economy, and short-term support measures for vulnerable and middle-class households and SMEs. Let me now touch upon two very important milestones of last week for the government and the country. So the one is the approval of the first budget of this government, the budget for 2024. I mean, the budget is structured around a macroeconomic analysis that talks about a growth rate in 2024 of 2.9%, so around 3%, and the same estimate also for the years to follow. It prioritizes on strengthening social spending, which is increased by about 14%, as well as implementing development projects. There is an increase of 15% of development expenditure in the current 2024 budget. with special emphasis on the projects of the Resilience and Recovery Plan. But at the same time maintaining fiscal discipline, which is very important for the government. So fiscal surplus for 2024, according to the budget that was submitted actually today to the House of Representatives, is estimated at 2.2% of GDP. And most importantly, we have a medium-term goal of public debt below 60% by 2026. So this is very important, and I mean, we heard before how much fiscal policy is important in this fight against inflation. Yes. This approach also, I mean, another issue that I want to touch upon, the new budget has a very limited increase of public posts in the government, which is also very important. I mean, it's important to make sure that every position in the public sector is actually being, evaluated. Also, the second very important milestone of last week, of course, was the upgrade of the Cyprus economy by 2 notches by Moody's. This means that this was the only rating agency that had Cyprus below investment grade. It is a very important milestone. It's not enough. We need to improve even further regarding our investment grade. So we are not stopping there because we reached the investment grade with Moody's. But of course, it's a very important milestone for the economy. And this has been achieved through the sacrifices of people in the last decade and disciplined fiscal policies. And I think it's a reward for the previous government, but also a trust to the current government's fiscal policy. So this is very important for us. It's very important also for the banks that they also have been upgraded. It can help us bring more investments into the country. It's very important at this very high level of lending currently that we have the investment grade. And it's something that we look forward to work with everybody, to make most use of it. However, there are still risks that we need to address. We're not stopping here. We need to be very prudent on all our policies. As I said, 3 main things: fiscal discipline, macroeconomic stability, and also continuing reforms in structural reforms in the economy. So this is from me as an opening statement. I would like to hear both from Mr. Nicolaou and Mr. Evianiou that they come from different sectors, but important stakeholders in this effort for the economy.
Thank you very much. Well, Mr. Nicolaou, you have the floor. Yes, please use the podium. I didn't mention it in the first place.
Good afternoon, everyone.
Mike.
Thank you, Governor, for the invitation. We have been through a very turbulent period locally ever since the global financial crisis in 2008, 2009. We have the Euro crisis in 2010, 2014, our own crisis 2012, 2014, pandemic in 2020, and the ongoing war in Ukraine. We see a continued great power rivalry between global powers. We see reversing globalization, and all these are naturally inflationary. In this context, monetary policy is aggressively tight, and there are steep currency realignments. The risk of policy errors, where central banks tighten more than necessary, harbors risks of deeper recession that we may now anticipate. In all this turbulence and pressures, the economy of our country has shown remarkable resilience and provides cause for optimism, but we shall remain mindful for downside risks. So I will say a few words now about the banking system, because this is the reason I'm here. So the resilience of our banking system, local banking system, has improved steadily all these years, starting from positions very different than what they have been 10 years ago. The banks restructured their operations, we shrank our balance sheets, we steeply reduced our non-performing exposures, the liquidity is significantly improved, as well as the capital adequacy. We have refocused mainly on Cyprus, scrapping the overseas exposures. Profitability is improving, and this is not bad, as higher interest rates unlock the value of a large and stable liquid assets and solid deposits, as well as provisions are reducing because of better portfolio quality. So high profitability is natural, turns to improving bank valuations, better access to capital, lower costs, and at the same time, we improve our internal capital generation, which is the most important thing because this helps us absorb any future risks. Yesterday, as Irene mentioned, after the upgrade of the country, Moody's has upgraded certain banks to the investment grade, and this was the first time after more than 12 years. This is good news for the banks and, of course, good news for the country as well. The prudential oversight has been strengthened. It's obvious, we know it very well, we feel it every day, and it's good for the country. Cost-to-income ratios have decreased, but on an average remain relatively high versus peers. Higher inflation rates, higher inflation means higher interest rates, means slow down the economic activity, means fewer or lower growth in terms of new lending. But loan quality risk, which is the most important of all, are moderated by relatively strong growth, low unemployment, and the continued recovery of the tourism sector, together with a tighter underwriting standard. Tourism probably this year will be the best year ever. I mean, we are heading to a better year than 2019, which was our best year. The country's ratio of non-performing loans was 9% in April, but it's important to say that about half of these are restructured facilities, and at the same time, the coverage ratio is 54%, which is relatively high. What I call active private indebtedness, which excludes the loans outside of the system. So active private indebtedness, it's the bank loans to residents are actually just 21 billion, which is 72% of the GDP, which is the lowest it has ever been. So active, I emphasize the word active, private indebtedness is relatively low, which reduces vulnerabilities and reinforce resilience in times of crisis or economic distress. Meanwhile, the capital adequacy of the banking system, it is the highest it has ever been, with Tier 1 ratios almost 20% as of December 2022. Going back to QR new lending, it's a little bit strange because in Cyprus until July, the QR new loans, excluding any restructure or refinancing, are roughly 2 billion, which is slightly higher than the corresponding period in 2022. So we are going in a different direction than the rest of Europe, but not much. And this comes mainly from businesses, because business loans probably have been aided by recovery programs like digital and energy transition. QR new lending to households, lagging, yeah, you have to say that, mostly due to lower mortgage loans. It's also important to mention that we operate in a very, very liquid market, probably one of the, if not one of the most liquid markets in Europe. I mean, as far as deposits are concerned, we have deposits around 52 billion, out of which 42.5 are local. So if we consider and compare this with the loans, which are 21 billion, then we have double deposits than loans, and this is healthy. And it's healthy because we don't follow also the European example, which shows that in 2023 there was some reduction in deposit. We are relatively stable versus the end of the year at 42.5 billion. Not much, some ups, down, but we are relatively stable, and this is also important. So challenges and outlook. I will start by saying that the gross domestic debt, as Irene mentioned, reduced to 26.5%, and we expect to continue and decline. This is our expectation as banking sector. And also it's important to mention that the debt affordability metrics remain favorable. Interest payment on public debt are, in relation to government revenues, are close to 3.6%. We are more than 9% back in 2012. So these are encouraging ratios, in my opinion, that underline favorable debt dynamics and sustainability of the public debt. And the long average debt maturities of the country assure that interest payments as a percentage of the GDP will continue to decline or continue to remain manageable. But higher interest rates means higher risk, elevated risk, and it is important to understand and know our financial vulnerabilities. But I am positive. I am positive because there are indicators that point toward a more reassuring and more positive outlook, like, for example, the degree of leverage of our non-financial corporations, the degree of profitability, the level of non-performing exposures, the degree of capitalization and resilience of the banking sector, and so on. My concerns remains on the policy dimension. Interest rates can rise too far and stay high for too long. This is recessionary. Now, a mild recession is always part of a business cycle, but we don't want this tight monetary environment to lead to a more serious recession, because that will have more serious and more lasting consequences. So how high and how long are the governing council, the ECB, is prepared to take the interest rates? It remains to be seen. This is an area of uncertainty, and we need to remain mindful about that. But we feel comfortable with the microeconomic parameters of the public finances and with the strength of the balance sheets in the banking sector and the strength of the regulatory framework and adequacy of our capital buffers. And that is a very good position for the country to be in, because all these buffers, if they are combined with prudent policies, can help us withstand any future crisis, and at the same time protect the social cohesion of the country. And because the vice chair of the ECB, he's not with us now, but we had a short talk yesterday. He was a finance minister of Spain, a member of the Eurogroup Bank in 2012, 2013, which you remember what was the name Eurogroup in 2013. And he was in a position to realize the magnitude of the progress of the country, and we shall all be proud about it. And because we also know what the country has been through all these years, we know, all of us, we need to remain vigilant for downside risk, We are not at the end of the crisis. Uncertainty is high, and the margin of error for countries like us, small countries, outliers in the euro system, the margin of error is very, very small. Thank you very much.
Mr. Ianiu, the floor is yours. You want to go to the podium?
No, I'll
at your
speak
position there? It's fine.
Well, first of all, thank you for the invitation to be part of this panel and to participate in this conference that I hope it will become an annual event. It's obvious, I think, to everyone that has been in this room over the last few hours, but also before even coming here, that currently the objective of monetary policy is to cool down the economy and bring down inflation. But our task as Invest Cyprus is, despite that, to promote the country, to attract investments to the country, to facilitate new investments and to stay in touch with investors to address their pain points so as to drive economic growth. So we're having, in a way, an uphill job to do given the prevailing conditions. I think it was the economist Paul Romer who said that production growth in the economy comes by rearranging the resources to make them more valuable. He made the metaphor with cooking by saying that you try to produce better recipes so as to make better products and reduce the side effects. And I would say that as far as economic growth is concerned in Cyprus, we have at the moment new recipes in terms of driving growth. We have Vision 2035, which is an action plan. There are 242, I think, actions included there that need to be implemented, of course, and executed, that aim to make the economy more resilient, more diversified, and the growth more sustainable, but also the Recovery and Resilience Plan, which is aligned with that, with the Vision 2035 and runs over the shorter term. Our priorities at Invest Cyprus are aligned with these two plans. And there are two pillars. The first is the national strategy to attract to Cyprus high specialization companies and talent. And the objective there is not only to bring to Cyprus thousands of highly paid employees, which has happened over the last 2 years, that obviously they contribute to economic consumption and to growth, but also to bring companies that create a more diversified economy, that makes it more sustainable to external, more resilient to external shocks, growth more sustainable, but also drives knowledge transfer to the economy in the effort to move faster as far as digital transition and green transition are concerned. Cyprus has been very successful in 2022, and we continue in 2023. Although we experience a slowdown, monetary policy is working in attracting many such companies to Cyprus. There have been, of course, side effects because of capacity issues in the economy, but this growth has contributed significantly to economic growth in 2022 and 2023, and this is cited also by Moody's in their recent two-notch upgrade of the economy, but also by the IMF and also by the Central Bank of Cyprus. The second pillar of our strategy focuses on attracting to Cyprus investments for greenfield projects that are in the space of the green and digital transition of the country. So we're looking for investments in sustainable projects, in projects that make the country move ahead in its aspirations. I have to say that at Invest Cyprus we have a data bank of projects that are ready to be invested, mature projects, but not a sufficient number. There is interest from abroad, but we don't find a sufficient number of projects available. So I would like to take this opportunity, and since I see in the audience distinguished members of the private sector in Cyprus, I would encourage you to consider projects that are aligned with this strategies that look for investments in order to promote them to investors from abroad. Having said this, there have been investments in light manufacturing, in the energy sector as well. The final point I want to make is that it is clear that with monetary tightening, it's going to be increasingly, and fiscal, of course, discipline that is absolutely required. It's going to be increasingly difficult for governments to tap the market for fresh financing, to finance projects, infrastructure projects, etc. On the contrary, and especially in Cyprus, we need to stay disciplined and on a trajectory of reducing debt. And therefore, foreign investments become much more critical in terms of continuing to have infrastructure projects in the country. And therefore, I would like to take this opportunity to encourage more private-public sector partnerships in the space of foreign direct investments in order to drive the development of infrastructure in the country, the green and the digital transition, without necessarily having to use the limited space that we have to borrow from the markets. In concluding, I would like to say that Invest Cyprus doesn't have any executive authorities. We're working closely as a facilitator with all government departments and with the public and with the private sector in order to help the country move forward on the basis of the current plans for economic growth, Vision 2035 and the Recovery and Resilience Plan, which, as I said, are our new recipes aiming to produce better quality growth, more and lead to a more diversified, a more resilient economy and greater sustainability for the country. So I look forward to the questions and the discussion. Thank you.
Thank you. Thank you all. Okay, the format is the same. I will have one question for each of you. The other can add a comment for a minute, and then we'll open the floor for questions. Ms. Piggy, well, I'm sure that you heard the previous panelists talking about the need for the coordination of fiscal and monetary policy. And my question is, what are the measures taken by the government so far to assist the vulnerable to cope with high prices, and what are the future plans, if you may reveal?
Thank you very much for the question. I mean, indeed, as soon as we took office, I mean, the pressure to take measures or to continue existing measures was very high. One of the main issues that we had to reach an agreement on was the cola issue that we inherited for the previous government. There was an agreement reached very early during this government's termship, and this was due to common ground found between all stakeholders. And I want to thank them again once more, because some of them are here today on the stance they took. So it was a very important social measure we considered in order to help workers and their purchasing power. Then there were the very targeted measures on electricity that we still keep on vulnerable people and also on farmers. This was not an easy decision, and we see still, in the newspapers every day discussion about abandoning the more horizontal measures. But as was discussed before, it's very important that we keep on having only very targeted measures for the vulnerable people in order to have, the fiscal policy follow correctly the monetary policy. We are also discussing now on a number of measures, again, very targeted measures for the vulnerable people. We're discussing a measure on photovoltaic panels for everybody. So in order to make energy is one of the biggest costs that the households have right now. So we're discussing on a measure in order to make it easier for people to have cheaper and green energy in their houses. and I'm sure the minister will be addressing this issue and making announcements very soon. So this is overall the stance of the government. I mean, we have to stay on a prudent fiscal policy stance, and that's what we're aiming to do. And also, just before finishing, since Panicos is here next to me, it's very important to see what the banks can do regarding their interest rates. It's an issue that we hear all the time. It's very important because I talked about electricity. The other big issue for households and businesses is mortgages for households, of course, and interest rates on loans for businesses as well. So we have a very healthy discussion and dialogue with the banks that we need to continue. And I think now with the upgrades, they need to do a bit more for the people. Thank you.
Mr. Nicolau, I'm sure you would like to add something here.
Generally on the rates, we need to see why this is happening in Cyprus. So first, most of the borrowers, and especially the housing loan borrowers, choose in the past a floating rate. So, which is not the case in most of the European countries. There are countries where their mortgage book is more than 90% fixed rate. So because of this, the transmission of, let's say, the monetary policy, meaning higher rates after each time the ECB increases the ECB depo rate, it's automatic. On the other side, we have a very, very liquid market, very liquid market. I mean, double deposits than loans, which the depositors in the country actually spread their deposits in many banks. And this naturally delays the transmission of the monetary policy of the deposit rates, which it translates to, it takes time on the deposit rates to pick up. But that is why there is a high spread between the yields and the loan yields and the cost of the deposit cost for the banks. So I expect this spread to decline in the near future because hopefully and naturally we're approaching the peak on the increase of the rates. So the back book pricing will not continue to the same extent that happened the last 1 year. At the same time, and this answer partially is Irini's comment, the new loans, and I know that specific banks will also offer new loans for specific segments of the population, are actually priced lower than the existing loans. So housing loans in the market is priced between 3% and 4%. And at the same time, we see banks offerings, and I'm sure that this will continue offering higher deposit rates. So in a couple of months, we'll see this spread to decline. As Bank of Cyprus, we have published in our, let's say, projections and guidance to the investors that we will pass through 50% of the ECB rate to our depositors.
By when?
By June 2024.
Okay.
Gradually. But it doesn't mean, I mean, we have offered high deposit rates. We have 70% current, I mean, on demand, and 30% tenor. And we have offered higher rates, and this has been moved to 69, 31. So we expect this gradually, as we increase the rates, to move to 50-50, and so that it's in balance. But we are not too much outlier. I'm using statistics in terms of especially loans, both on housing and on businesses, new loans. We are not an outlier in the European Union. I would say that especially for housing and for consumer lending, we're actually on the low side.
Mr. Eugeni, would like to add something to it, to this?
No.
Okay, and because you had a pitch from Mrs. Piggy, and you also almost answered my next question. So, okay, from a credit risk standpoint, okay, these continuing rate hikes, did it cause any inflow of NPLs? Did it pressure your balance sheet? I mean, totally as a banking sector here.
No. Simple answer, no. So far, the new NP inflows are not significantly or materially different from what we have during the low interest environment. So the simple answer is no. So people actually are prepaying their loans faster than normal because of the higher rates. So we are seeing, as a banking sector, higher repayments instead of no repayments. So we see higher repayments in the system.
Okay, Mr. Eugeniu, okay, my question is on a point that you alluded to in your speech, is the attraction of ICT and high earners last year, which was one of the drivers of the strong growth we had in 2022. And my question is, can we sustain this, and what are the challenges that emerged from this inflow?
Well, yeah, it's a great question, because we shouldn't take for granted that the companies that move to Cyprus, not only in the ICT sector, but in other sectors, but predominantly in ICT, will in fact stay in Cyprus for the long term. So we have to be vigilant in terms of making this sustainable for the economy. And I would like, I'll make a few comments, starting more generally about the companies that have come to Cyprus, not restricting my comments to the ICT sector, and then I will move to the ICT sector. In the recent meeting that we organized with the President of the Republic, it was a round table with investors. They aired their, let's say, their issues. And one of their main issues is the fact that there is a capacity problem in the economy. There is lack of availability of housing, lack of availability of positions in English-speaking schools, and this obviously poses a limitation for new companies to come to Cyprus, but more importantly for the existing companies to continue to grow, because when a company decides to make Cyprus as its base, it starts with a small number of employees and then it aims to grow over the years. So this is one factor that needs to be addressed broadly. Moving to the ICT sector specifically, we need as a country to move faster regarding our digital transition. It is not possible to have an ICT cluster in a country that is lagging behind as far as its digital capabilities are concerned. And despite progress, we are still, lacking in that regard. And that, of course, has to do with the digital transition of the public sector, but also of the private sector, but more importantly, the digital upskilling of the workforce in the country. And that means, people that are already in employment, but also new school leavers and new graduates. And that links to the educational reform that is necessary to provide to our children the skills that they need for the 21st century. And the skills are not only digital skills, but also the soft skills that are necessary to thrive in an economy where technology and AI will potentially take up many of the mundane tasks that are being done today by humans. So this is a bigger and more medium to long-term challenge for the economy. And my last point, specifically on the ICT, but also the fintech sector, is that we need to protect the reputation of the country. And this is the role of the regulators, especially in the fintech sector, to ensure that regulation is robust and we protect our country from any sort of incidents that may tarnish our reputation, specifically in the fintech sector. Therefore, I believe that we have been successful. We continue to be successful as far as attracting companies to Cyprus. The challenge also is to create clusters in other sectors like, for example, biotechnology, the biomedical sector, where, in fact, it seems that as Cyprus we have more people with skills compared to the IT sector. But beyond creating new clusters, we should make the existing cluster sustainable and address the pain points of investors who have already chosen Cyprus to make sure that they stay here.
Thank you. Anybody would like to add, Ms.
Yes,
Piggy?
if I can add to what Evgenio said, and I mean, I fully agree with him that it's one thing to create an attractive business environment, but it's even more difficult to sustain it. And you need to do continuous reforms in order to sustain it. And I think Evgenio's touched on two of the most important challenges that we're facing now as government. The one is a digital transformation. I mean, we did set up the Deputy Ministry on Digital Transformation just a few years ago, but there's huge work that has to be done, and we cannot claim to have a big ICT sector here if we don't do enough for the digital transformation of the country. So this is one of our main objectives, to work on the work that was done in the previous years, but we need to do things faster regarding digital transformation. The other issue that Evgenio's touched upon is the housing issue that we were facing now in Cyprus. And it's interesting, even if those companies are raising it, imagine how much bigger it is for the local population. The Ministry of Interior is working now on a number of measures on affordable housing that they're touching both on the demand side and the supply side, because you need to cover both sides in order to have a result regarding affordable housing. We're working on all these challenges, as Evgenio said, and also the government is going to be hosting another roundtable with local business people, because it's not enough only to hear about what foreign investors have to say and the problems they're facing in growing their business here in Cyprus. But we're very eager also to hear about what local business say and what problems they are facing in expanding their business and exporting also, because another issue that we need to touch upon is the current deficit. That we need to maybe have another discussion on this, but we need to have a discussion on this and how we're really helping our businesses. Thank you.
Well, okay, briefly, we'll open the floor for...
Yeah, a minor comment. Credibility, stability, and reputation. Whatever we do, if we don't have these three, I don't think that it's easy for us as a country, a small country, to attract any investor, because investors, they don't invest for today, they invest for a number of years to come. So we need to convince them that we're a credible partner, that we care about stability of tax, legal, financials, and of course our reputation. It's the perception that we have on AML, all these things is actually perception, not reality. So these are very important for the country.
Well, thank you. Now let's open the floor for questions. Please.
Can you please elaborate on the prevailing trend in Cyprus of velocity of money using aggregates M1 and M2? Thank you.
Can you repeat more clearly, because we couldn't hear you clear enough?
Can you please elaborate on prevailing trend of velocity of money in Cyprus using aggregates M1 and M2?
Using the velocity of money using?
Aggregates M1 and separately M2, because my question is based on the lack of statistics on the Central Bank of Cyprus side since 2008. Otherwise, we could calculate it ourselves. So that's why I'm asking.
Okay, I think this question refers to the data division of the central bank. I don't think our panelists could answer this question. If you have something else, we will gladly discuss it. Please give them the microphone again.
Yes, it's a very important index and factor, and I think we cannot judge the health of the economy without knowing it. According to my calculation, over recent years, it's dropped from 2 to 1. And you can find this data for any EU country except Cyprus. So then the next question, how we can judge the role of monetary policy if we don't know this index?
I'm really sorry. Okay, let's not engage in a discussion here. You're talking about data that we do not have access to.
I'm talking about velocity of money. This is the speed of circulation of money in Cyprus.
Okay, I think it's better to refer. Please, Mr. Rodoto, he has the mic, please.
Let me try to answer that. Firstly, let me refer you to what Ernest Knan said about this, and he referred to the speech of Isabel Schnabel, whereby Isabel, who's an executive board member of the ECB, analyzed in her paper the relevance of the transmission of the monetary policy in terms of interest rates or the volume of money in circulation. And as Ernest answered previously, it's more important that for the transmission of monetary policy to look at the level of interest rates and its transmission. And this has been happening, and as the chairman of the Association of Cyprus Banks mentioned, since we have a very high level of variable rate mortgages in Cyprus, we have a very high transmission rate, and therefore we are faring even better actually than the European, that the Eurozone average in terms of inflation, even though we are doing better than the European average in terms of GDP growth. So we are monitoring the transmission level, and the results are shown in terms of the inflation outlook and how better we're doing in terms of the European averages.
Thank you. Well, anybody else? Sir, please, over there. Okay, afterwards.
Thank you very much. The question that I have is mainly for Mr. Panicos. In regards to the spreads that you mentioned between the difference from the loans and the deposits, I hear the two reasons that you refer and are valid, but is there any kind of regulator or someone, an authority like ECB or Central Bank of Cyprus, that it is responsible to take necessary actions to correct this kind of spread that currently we have?
I mean, you mean impose a spread on the banks? No.
I mean, let's say in the loans we have a specific type of interest rate, and in the deposit it is far lower, let's say. So we have this spread that you mentioned. Is there any authority that it is responsible to take any necessary action on that, or it is totally responsibility of each bank to take the decision?
It's banks to take the decision.
Okay. Thank you very much. And one more question.
Okay, make it brief, please, since you got the second one. Go.
Yeah, thank you. The second one is in regards to the renewable energy and the solar panels, let's say, that we can have in our house. Is there any plan when these solar panels will need to be abandoned, how we will find a way to replace them, or to use a way to dispose them correctly? Because in US now they are facing a lot of issues with this way that they are throwing, let's say, the solar panels everywhere.
I mean, if I can answer this.
Please.
it's a very valid point you're raising. And we need to see both about solar panels, but also about batteries, how we recycle them, what we do with them after their end of life. I know now that technology is changing a lot. It's adapting to it. And for example, for batteries, there's a lot of technology now to recycle all parts of the batteries and reuse them. And the same is happening about solar panels, but you're right about it, because moving to green energy, to the green economy, it's important also not to just put the solar panels, but see what the next step is in terms of cyclical economy. Thank you.
Anybody else want to answer this one? Well, any other questions? Please, sir.
Generally, question goes to Central Bank of Cyprus. I represent some family offices, and as an investor, I could consider that the confidence of investor investing its funds to Cyprus in banking units still remain weak, considering the fact that has been in 2013 the haircut. What other safeguards are there so we can present to those investors so we can somehow improve their confidence, so they can move the money into banking institutions in Cyprus?
Okay, I think in my introductory speech I explained the resilience of the banking sector, the huge improvement that we have been through all these years. We have one of the highest liquidity coverage ratios, very liquid sector. We have one of the highest capital ratios. And as I already mentioned, we have been very, very recently upgraded to investment grade. So these are all facts that can help you promote Cyprus banks to your investors.
Just one quick comment from me. I mean, a bank deposit is not an investment.
It's not an investment, yeah. But yeah, it's not an investment per se.
Okay, the last one here. The microphone, please.
Okay, I'm running the risk of sounding pessimistic being the last question, but I'm going to attempt the question. We have a European Union that has various sizes of economies, so whether that be bigger economies, smaller economies, economies that may rely on more on energy, economies that may rely on domestic policies. We know that Cyprus is a small economy. I think we have managed very well during the crisis to manage and to show positive growth, much more higher than the EU average. But at the same time, there is a feeling, and I want to hear the comments, that with one common fiscal policy within the European Central Bank of increasing the interest rates to tackle maybe bigger economies issues, we are feeling as though we are being pushed back as a country. And Evgenos mentioned that there is an attempt to bring new business to have growth in the sector, but there is always an uphill struggle, as you mentioned. I'm just quoting. At the same time, we are seeing the banks keeping the margins, their spreads at high levels, therefore impacting the businesses. Those impacting the businesses also are the wages. The people are being impacted by mortgage increases. There is a wage demand. Those will impact businesses, which again will increase their prices to recover their increased costs, which creates a spiral effect on the inflation, which the central bank is trying to tackle. So it's more of a spiral and an uphill struggle, and I want to see or hear your comments how we deal with this, given the small size of our economy, that probably we can handle it much easier than the bigger economies that may have bigger issues.
Okay, who will go first?
Okay, well, first of all, let me say that from an investment perspective, in the medium to long term, the objective to bring inflation down to 2% or thereabout, I think it's going to be very helpful in terms of creating a positive investment environment in the Eurozone and in Cyprus. Therefore, inflation is not conducive to a good investment environment. And inflation is an indirect or direct taxation, anyway, on the economy, which is not helpful as far as investments are concerned. My comment was that, yes, I mean, generally, not only in the Eurozone, but globally, there is this effort to bring inflation down, and this is cooling down the economies, and because of the cooling down of the economies, there is a slower, let's say, flow of investments, a slower appetite for companies to make investment decisions, and that's to be expected. Having said this, I would like to repeat that my view is that we should stick with the discipline and in a way go through these tough times, because the objective of a lower inflation, as it was very articulately explained earlier by the presenters, is good for the economy, is good for the investment climate. And to answer your question, Pieris, I think this makes it much more urgent for Cyprus to focus on the structural reforms that are necessary in the country. We know that we're not going to have a relaxed monetary policy, at least in the immediate to medium term or the foreseeable future, or whatever one may want to call it. We know that the space for fiscal expansion is not there. On the contrary, I think there is a need for fiscal surpluses to bring down public debt. We know that the private sector in Cyprus is heavily indebted because, yes, a lot of distressed assets have moved out of the bank's balance sheets, but they have moved to the credit acquiring companies, and they're still there. So what do you do in such an environment to continue driving growth, which we have been successful over the last couple of years? My view is that we continue with greater urgency on the structural reforms. And as I said in my initial remarks, a few years back in Cyprus, we were saying we need a plan, we need a plan. Now we have plans. We have plans which are adequately detailed. But what needs to be done is that those plans need to be executed, and they need to be executed with a sense of urgency. And where we are, if I'm worried about something, if I may, is the lack of urgency and speed of execution in order to make the changes that are necessary in the economy to continue growing, given the challenges that are there.
I mean, if I would only add one thing to what Evgenio said, is only targeted measures, and not go back to horizontal measures. And also exactly this, that we have this vision now, we have Vision 2035, so we have a specific path where we want to go as an economy, as a country, that hopefully it will not be affected by electoral cycles. I mean, it's there and it should be there until 2035, and this is where we want to take the country and keep reforming exactly like Evgenio said.
Not only affected, but transcends electoral cycles, because it goes from one government
to the next and the
next. It's a consistency issue here, I would say.
I think there is broad political agreement, as far as I understand, but the execution doesn't only have to do with the political cycle, it has to do also with the ability of the country, generally, the public and the private sector, to move quickly and to bring about change quickly. And I think this is an area that we need to address. Sorry.
Please.
On this point, sorry, I mean, the Resilience and Recovery Plan is a very good example because it combines funds from the EU, but at the same time the reforms. And it's the first time that the European Union, I mean, is doing this experiment on having together funds and reforms. It's not just for investments. So it's really pushing us to do a lot of reforms, both the executive but also the House of Parliament. So it's a very important instrument, I think.
Okay, although we are almost over, I will give you the floor, Mr.
No, just a comment, the general comment. There are things which you can do, you can influence, and there are things which you cannot, right? So being a small economy in the Euro system, obviously, the decisions are not, we are not influencing the European inflation so much, or the European interest rate. So we have to face it. We may be at a different business cycle than the rest of Europe. It may be the case, right? But I will again emphasize what is important for this country is credibility, stability, reputation, and I will add what Evgenios and Irene said, that we are lacking of the speed of execution. Reforms, yes, we decide, we think about it, we do meetings, but at the end it takes years. And because this country is very small, small positive structural changes will make huge positive effect for all of us. So it's very important to execute things. And my opinion is that unless we partner as public and private sector,
for sure,
we cannot go fast enough solely accounting only to the public sector, which we know how difficult and how cumbersome are the processes. You need to do an RFP, you need to do that, and then you go to the appeals committee. It takes ages, so, and then the country is left behind of many issues. So we have an opportunity now to address this and go as fast as we can.
Can I have one very
briefly.
last, Konstantinos Milaos? I think it's also important, what Panikos said, is public-private cooperation, and to be very specific on reforms, what you want to change. I mean, many times we hear as a government that we need to change things, but we don't hear exactly what we want to change. So be very specific, you know, on the reforms necessary, and we're there to listen and make the best out of it.
Many thanks to our panelists. And thank you all for being here. That's a wrap.